Options Trading for Beginners, a complete guide to learning how to make money and build a long-term profitable business with options trading. Written by Joshua Kratter. Narrated by William Douglas. Introduction. There is often confusion about why traders choose options when stocks and bonds do just fine. What some tend to miss out is the vast difference in the earnings potential. Stocks generally return a profit of 8 to 12% per annum, which is pretty impressive in and of itself. However, options are a lot more lucrative with a much more enormous potential. Some options trades typically generate profits upwards of 50%. Making 100% profits within a short period of time and even more is not unheard of. This is why a lot of experienced traders choose options. They are extraordinarily lucrative and highly profitable. It is also possible to make money trading options in any market condition. Traders can make money when the market is bullish, bearish, or even when it's stagnant. As such, you do not need specific market conditions, and hence profitability throughout the year is very possible. Experts agree that trading options offer plenty of benefits that are not provided by other types of securities. While not all traders want to engage in options trading, there are certain aspects of it that other traders find attractive. Potential for astronomical profits. One of the main reasons for trading options is the opportunity of making significantly large profits compared to all other forms of trade in the markets. This is possible even without large sums of money. The principle behind this approach is leverage. A trader needs not to have large amounts of funds to earn huge profits. For instance, with as little as $10,000, it is possible to make amounts such as $300,000 or even $800,000 by merely using leverage. Take the example of a trader whose trading fund is $10,000. The trader wishes to invest this amount in company ABC. Now the current stock price is $20, though this price is expected to rise. The trader could use the funds to purchase the shares directly and receive a total of 500 claims for his money. If the stock price were to rise to $25 within a month, the trader would have made $5 per share, or a total of $2,500 in profits. Alternatively, the trader could purchase call options of XYZ stocks with the same amount of money. The options would allow the trader to purchase back the underlying stocks within a certain period of time. Now, options contracts cost between $1 and $4, depending on certain factors, such as the value of the underlying security. In our example, one call options costs $2, so for the $10,000, the trader receives 5,000 options contracts. If the trader chooses to exercise the right to sell the underlying shares in the next month, then he stands to make a profit of $5 per share. Remember that he has a right to a total of 5,000 shares for a total profit of $25,000. This clearly demonstrates the capacity and power of options, as well as how useful this kind of trade can be. Significant risk versus reward consideration. Like all profitable traders, it is essential to weigh the risk posed by an individual trade compared to the possible rewards. When trading using options, then the style adapted will indicate the type of risk inherent in the transaction. The above example clearly shows how good the options trading process is. If a loss were to be incurred in the above instance, then the total loss would have been the cost of the options. In this instance, the risk is well worth the reward because the amount set to be lost is insignificant compared to the amount of profit to be made. In general, the higher the risk, then the higher the potential return. Any time that a trader considers a trade, then the risk versus reward ratio should be taken into consideration. As an options trader, you should know how to benefit from volatility. Volatility needs
Sample complete. Ready to continue?